The Financial Sense Midweek Edition with Jim Paplava. Delving in depth with authors and experts into the key economic issues.
Joining me on the program is Jim Rogers, who's chairman of Rogers Holding. He's also a best-selling author of A Gift to My Children, A Father's Lessons for Life and Investing in Hot Commodities, How Anyone Can Invest Profitably in the World's Best Market. And Jim, that's where I want to begin our discussion. You cut your teeth in the bull market of the 70s, in the commodity markets, and we were seeing a period of time, we went off gold backing of the dollar. We were seeing a lot of money printing like we are today. How would you contrast the commodity bull market that you see today to the one of the 70s?
Actually, things are similar in some ways and obviously different in others. In the 70s, the U.S. was a creditor nation. Now we're the largest debtor nation in the history of the world. So there's some significant differences. But basically, in my view, the markets are in a similar kind of period. Stocks did very little in the 1970s. They were in a big trading range for 18 years or so. Likewise, the stocks have been in a trading range again for the past dozen or so years. The commodities have gone through the roof, just as they did in the 1970s. In the 70s, supply and demand were seriously out of whack for commodities. They're seriously out of whack again. So we're in the middle of a big bull market, and stocks have serious headwinds and serious problems.
You've gone on record in recent interviews that most of your investments are in real assets. We see today the Fed is resorted to several rounds of quantitative easing. We have the Bank of Japan, the Bank of England, and even the Chinese are loosening up. Global central banks are printing money. And, Jim, that's got to be good news for real assets.
Well, it always has been, Jim, so I presume it is again this time, too. Maybe it's different this time, although, as you well know, those are very dangerous words in the investment business or in any business for that matter. Whenever governments have debased currency or reduced the value of the money, something has to go up, and usually what has gone up has been real assets.
Now, a lot of people are talking about China. China's slowing down. There's going to be less demand. If China's strength is weakening, in other words, their economic growth isn't as robust as it has in the past, do you buy that argument, number one?
Well, I do know that China has been trying to cool things off for the past 3 years. I hope it's working. Apparently it's working. It's difficult to read. No, all you know is what you read in the press. But they have been trying to do that. They've had a real estate bubble. They've been trying to pop that real estate bubble. Seems to me that, I know that part is working. They are cooling off real estate. That's going to have some knock-on effects in other parts of the economy. Well, you'll see some real estate developers and speculators going bankrupt in China, but that's not the whole Chinese economy. It's not the way it was in the U.S. when our real estate bubble collapsed. It'll cause problems, but not throughout the Chinese economy and certainly not throughout the world as it did in the U.S.
Now, one thing that we've seen rise year after year during this period of time, and it seems to be the currency of choice, and that is gold prices. Given where gold has been, it's pulled back, although it's still up this year, a little over 5%. We've got silver prices up 15%. Given the problems in the U.S. and Europe, in particular, a great concern would be the events that are now unfolding in the Middle East, where it looks like we've got 3 aircraft carrier battle groups in the region right now, because I see that I live in San Diego, where we have 4 aircraft carrier battle groups. Jim, what would happen to gold and the price of energy if war was to break out and we were to attack Iran?
I don't think you really have to ask that question. The price of oil is going to go through the roof. Gold is going to go through the roof. I'm not investing in oil or gold or anything because there's going to be war. But if there's going to be war, obviously what's going to happen is those things are going to skyrocket. They may drop for the first day or two, but as soon as people realize what's going on, they will go through.
Now, you've written recently on your blog, if you look at this year financially, we're no longer worried about a double dip. The leading economic indicators have improved. The stock market's up. And there's a sense that things are going well in the United States. And I like to use the analogy, we probably have the best looking house in a bad neighborhood. But you're on record to say the time to worry is not this year. This is an election year, and we all know what politicians do in an election year. They promise the voters candy and lollipops, and they're kissing babies. The time to worry is 2013 and to be panicked by 2014. Explain what you mean by that.
Well, first of all, I should point out, Jim, I don't have a blog. I'm not on Facebook. I'm not on Twitter or any of those things. There are people who have set up accounts in my name, unauthorized, but I just want to be clear, I don't have my own blog. I'm too incompetent or for whatever reason. But yes, every 4 to 6 years since the beginning of the Republic, Jim, we've had recessions or economic slowdowns in the U.S. You can do the arithmetic. So by end of 2012, 2013, certainly 2014, we're well overdue. We'll have another slowdown, another economic problem, perhaps recession. And when that happens, it's going to be worse than the last one because we shot all our bullets. We've gone deep into debt. Our debt is at staggering levels now, and it's getting much higher every day, every hour, in fact. So in 2002, we had a slowdown. 2008 was worse because the debt was higher. The next one's going to be worse still because of the staggering amount of debt which we have incurred. Not just us, the whole world.
When you look at this and you see situations like this, why do you think policymakers, because I've read prominent economists both in New York and Washington, they're calling for, you have individuals like Paul Krugman, they're saying that the government should be spending even more money and borrowing more money. Why do you think we fail to learn from history? Because we've seen, for example, in Reinhart and Rogoff's book, This Time is Different, the financial follies that our governments are committing now have been committed by many other governments previously, and they all end badly, yet we've failed to learn the lessons from history.
Well, Jim, first of all, I don't know that politicians have a clue about history, and if they do, it's usually a filtered view of history. They make it read the way they want to, or they think, well, that was then, we're smarter now, we know a lot more now, so don't worry. But the real answer is they want to get reelected. They want to get through the next election, and they hope and they feel that if they can get the next election, somehow or another things are going to get better. It's not. It's certainly not. The situation's getting worse and worse, as you well know, but that's their view, and that's why inevitably, once they go into decline, the decline continues until eventually there's a crisis or a crisis.
Now, we have just seen, or as you've described, a lost decade, at least in the stock market. Stocks are no higher today than where they were, let's say, 10 or 12 years ago. And it reminds one of what went on in Japan, which has seen 2 lost decades. You've been telling investors, prepare for another lost decade. Why do you believe that to be the case?
Well, Jim, it's pretty simple stuff. Our only way to even survive this decade has been by spending huge amounts of money, going deep into debt to prop things up. We're propping up failure right, left, and center, just as the Japanese did, and that has never worked any time in history. You cannot do well by propping up failure. You have to admit your mistakes, take your lumps, and start over again. Unfortunately, we're not doing that in the U.S. We're doing the same thing the Japanese did. You know, the Japanese for 20 years have not let people go bankrupt. You know the expression zombie banks, zombie companies. There are lots of them in Japan, and 20 years later, their stock market is down 75% from where it was 22 years ago. That is not a typo, Jim. The Japanese stock market is down 75% from where it was in 1990. That's going to happen in the U.S. too, because we're doing the same thing. We're propping failure. We're increasing our debt at a dramatic pace. We're printing money.
oh, this may work for a little while, but in the end, somebody has to pay the bills. You're going to run out of other people's money eventually.
You know, something that on the day that you and I are speaking, you're a day ahead of us in Asia, Jim, but Fed Chairman Ben Bernanke was on Capitol Hill, and he keeps referring to inflation being contained and this magic figure of 1.9%. I'm sure that anybody listening to this program would find 1.9% inflation hard to believe. And yet, if you take a look at broad measures of money supply like M2, it's increasing at an alarming rate. And that to me just tells me that there's more inflation ahead of us.
Oh, Jim, you're exactly right. When you said the listeners would find it hard to believe, I think they would find it impossible to believe. They know that inflation is higher than 1.9%. I mean, everybody listening to this program shops somewhere or knows somebody that shops, and prices are up. They're up a lot, whether the government lies about it or not. One of the interesting things is that nearly every government in the world these days acknowledges that there is inflation, except the U.S. We're essentially the only government in the world that claims there's no inflation. Now, I find it incomprehensible that every government in the world, every country in the world has inflation except us in the United States. This doesn't make any sense. We all pay the same price for oil, the same for cotton, the same for copper, the same for everything. So I don't know how much longer the U.S. government's going to get away with being able to tell these lies, which they're misleading all of us. There is inflation. Inflation is going to continue to get worse. We have shortages of all raw materials developing in the world, and we have most governments fanning the flames by printing money. I mean, it's always worked this way. It's simple stuff. As you point out, this has all happened before, and anybody who goes back and does a little homework will know how this is going to wind up. It always has. There may be setbacks along the way. I mean, if suddenly Spain goes bankrupt or something, you might see everything go down in price for a while. But then they'll just print even more money. So you better grab all the real assets you can. If there's war, of course, everything's going to go down for a while. Most things are going to go down for a while, not oil. But in the meantime, prepare yourself because we're having inflation and we're going to have more.
Where are the bond vigilantes in all of this? In the 70s, if the Fed would have made an announcement like quantitative easing, as they've done several times, or Operation Twist, and the money supply would be growing like it is today, the market would pick up on that, the bond vigilantes would show up, they would drive interest rates up. Where are the bond vigilantes today?
Well, they're overwhelmed by the central banks. Central banks around the world are pumping money into the bond market. The Federal Reserve's balance sheet, you'll know that they've been increasing their holdings of interest-bearing securities, likewise in Europe, everywhere. So at the moment, they're overwhelmed by the central banks who have more money than they do temporarily. But eventually, the market always has more money than any central bank or more money than all central banks combined. So they're being overwhelmed at the moment, but it'll come back. I shorted some bonds, long-term U.S. government bonds recently. It doesn't mean I know what I'm doing, because I've shorted them 2 or 3 times in the last few years, only to get stopped out. But I'm back again, taking on the central banks, probably with the same results. But eventually the bond market is going to be finished for years to come.
Do you see this as something that just revolves from one country to another? I mean, the bond vigilantes did show up when it came to the debt instruments of the PIG countries, beginning with Greece. They moved on to countries like Spain, Italy, Ireland, Portugal. Do you see this as sort of kind of a roving market where, the bond vigilantes just show up on one particular country or a series of countries, and perhaps maybe next they move on to